Financial management, 5, right? So let's write it up. Financial management, 5. I actually want to continue today with the statement of cash flows and finish chapter 2, the basics of finance. So, repeating from last time, we have number 1, operating activities. Operating activities. Okay, let me clarify. I'm on page 39. So, I'm continuing page 39, and on page 39, you look table 2.3. At the top of the page. Section 2 is long-term activities. For some reason, I kind of like in the good old days, I knew it as investment activities. So the first one is operations. The second one is investments. The third section is financing. These 3 constitute the general functioning of the firm, and these 3 jointly, when you put them all together, will give you net cash flow. Net cash flow. All right. Net cash flow, positive net cash flow is called cash inflow. So, if it's positive, we'll call it cash inflow. If it's negative, we'll call it cash outflow. And now we come to section number 4. Which is the summary. And the summary section is actually fairly simple. Let me see how they have it over here. Cash equivalents and cash. All right, here's the way I know it. It's actually amazingly simple. Cash is basically a stock variable. So you simply say that's in most elementary accounting that you ever have, beginning balance. Beginning balance. When we say beginning balance, we mean beginning cash balance. Beginning cash balance. So the beginning cash balance will be 4.1. It's just a number I'm picking up from the table over here, which I'll continue to explain. This is on January 1, how much cash you had available on the balance sheet. Now, this beginning balance is exactly the same as the ending balance of last year. All right? So, December, I'm just giving you here a simple example. December 31, 2010 is the ending balance for cash flow. So much, sorry, not for cash flow, for cash. The cash balance. And this just happens to be overnight the same as January 1, 2011. So if you have at the end of December 2000, at the beginning of January you will have 2002. All right? So you have beginning balance, and then you say plus. And the second piece is net change. But what is the change in cash? It's simply the net cash flow. Let's see what's the net cash flow. 980. In this particular case it's plus. And then you simply have ending balance. And the ending balance is just add up these two numbers to 580. All right, now when you open the book, you see first what it says. It says net change in cash. Net change in cash is this piece, net cash flow. Then the second line is cash in equivalents at the beginning of the year. Cash in equivalents at the beginning of the year is the same as beginning balance. And then you have cash in equivalents at the end of the year, it's ending balance. Okay? So that's the ending balance. And that's the number. And this is the summary. The summary tells you beginning balance, how much you add or subtract, we call it the net change, and then the ending balance. That's it. That's the most simple, straightforward. There's nothing complicated. It's easy. And that's it. That's the statement of cash flow. Let me see what else I have over here. Okay, next one is statement of stockholder equity. So we're switching to page 42. Page 42. Stockholder equity. What's the two here? Okay. So, stockholder equity simply has two main components. The first component is basically capital, which is the capital from last year, and then retained earnings from this year. Okay, retained earnings, I've been explaining this many times, I'll repeat it again, is not an asset. Retained earnings is a claim on asset, okay? It is a claim by shareholders or by stockholders. It is a claim by stockholders for their past profits. So the form of retained earnings is not clear. In other words, the business may have reinvested the profits by keeping them in cash. They may have bought a machine, equipment, land, or any other. So what is the form? In other words, what asset represents retained earnings is totally unknown. The only way to know is basically you simply look at the balance sheet on the asset side and know. Retained earnings is part of equity. All right, let's see what we have here. Oh, well, that's fairly straightforward. You have beginning balance, same as before. And after beginning balance, you add plus retained earnings. Whatever the retained earnings are. And then you say minus cash, or actually it's going to be plus let me see, cash dividends. Dividends. All right, let's get back in the sidetrack here is you have net income, okay? Net income. And net income is retained earnings, okay? And dividends. Now, let's explain and open a new section to make it simpler and easier so that I can understand it. And it's fairly simple. You have retained earnings. This is what we call the old retained earnings, beginning balance. Beginning balance. So this is the retained earnings you start from last year. And now you say plus net income, okay, the profit for this year, and then say minus dividends, okay. And what's the net income and dividends? The net income and dividends give you the change in retained earnings. So these two pieces jointly will give you change, or we call it increase in retained earnings. Okay, so retained earnings for the current year, okay? So you have beginning balance of retained earnings. This is retained earnings that has been accumulated for all years up to the beginning of this year. Then for the current year, you got net income and dividends. So we call this now current year. This comes from the income statement. From the income statement, you get the net income, okay? And you subtract the dividends, and you get increased in retained earnings for the current year. And then you simply draw the line and say ending balance. And this is the ending balance for retained earnings, okay? So, now what about equity? I guess, this is... What about equity? Equity has two components. The first component is called paid-in capital, and the second component is retained earnings. All right, so to get the equity, you simply add these two, okay? Now, this retained earnings is the ending balance of the retained earnings, okay? So the question is now, what is the paid-in capital? Let's do paid-in capital exactly the same way. Paid-in capital is having beginning balance what adds to paid-in capital? Only stock issue. That's it. Stock issues increase paid-in capital. So you say plus. Sometimes they like to call it stock issuance or stock issue. It's the same thing. And you will subtract if you have a stock buyback. Also, I explained it last time, called stock repurchase. Stock repurchase. And this simply gives you ending balance. All right. So, a different way of saying this whole thing about the equity now is you simply have old equity plus changes in retained earnings plus changes in paid-in capital, okay? And that's it. That's all there is to it. Now, the dividend will be part of retained earnings, all right? So, I have to figure out exactly what they have here. Net income, cash dividends, addition to retained earnings. Aha, I see what happens here. This is table 2.4. Table 2.4. Table 2.4. Basically, they said add net income, subtract dividends. So add, let me see, the retained earnings. Add net income, subtract dividends, and basically what they said, hey, this is the old equity, add the net income, subtract the dividends, which is the increase in in retained earnings, and then they say this is the new equity. Okay? So they did exactly this piece, and basically they ignored the paid-in capital because this was 0 and this was 0. Very commonly, corporations have no change in paid-in capital during the year. Usually, rarely, very, very rarely, corporations will issue new stock and increase the number of shares outstanding, or will buy back stock. So usually, the paid-in capital piece has little change. So they take old equity, add the profit, subtract the dividends, that gives you the increase in retained earnings, and that's how you get the new equity. And that's the piece here on page 2.4. Let's see what else we have. All right, 2.6. 2.6, let me see how I'm going to get this, is free cash flow. It's a little tricky concept, and usually even MBA students struggle with it, but it's fairly basic. It took me like half an hour a few years ago to figure out what it is. So let me see how to explain it in simple terms. Free cash flow. And that's section 6, 2.6. And that's on page 44. So, what is a free cash flow? It's very simple. This is all cash flow which is left after satisfying all business needs. After you satisfy all the cash needs that you have. And let's see what are the pieces. The first piece is EBIT. One minus T. EBIT 1 minus T is net operating profits, after tax profits. Let's write it out in red. After tax Alright, so it's basically what the business made profit, what kind of profit the business made. That's all there is to it. And 1 minus T after paying for the taxes. Now, this particular piece NOPAT is known as NOPAT. And that's on page 44. It simply says net operating profit. That's just the operating profit after tax. That's it. Nothing more, nothing less. The net operating profit after tax. And now you have two pieces. Plus, you have changes in net working capital. So you have increase, decrease, we just call it delta. Increase or decrease in net working capital. Well, what is net working capital? And here's a very simple explanation. This is basically short-term capital. Short-term capital. And what is short-term capital? Short-term capital is question number 2 from your midterm, which you just did 1 hour ago, which is current assets minus current liabilities. So this represents all the capital which is needed to finance current assets and current liabilities, and working capital is basically current assets minus current liabilities will represent net working capital. And all you want to see is the increase in net working capital. Alright, let's think of it in the very simple and easy way. The simplest and easy way to think is there is no change in current liabilities. And there is no change in current assets except for inventory. So you're selling before computers, you keep in the store 10 computers. Now you increase the inventory from 10 computers to 12 computers. When you increase from 10 to 12 computers, you need extra working capital to finance the 2 new computers, okay? And the 2 new computers will be financed effectively from after-tax profits, all right, from retained earnings. So, basically increase in net working capital is essentially extra capital to finance the 2 extra laptops that you want to sell. That's it. So, a businessman will need to find the cash, the working capital, which is short-term capital. Okay, capital used in this case for inventory. All right, and the other piece of capital is the long-term capital. And they have it as plus changes in capital expenditures. Well, what is capital expenditures? Capital expenditures is basically long-term assets. These are basically investments, okay? We also call them fixed assets. Well, what does this capital expenditure represent? Long-term capital. And basically that's it. That's the whole explanation. The whole explanation is whatever is the operating profits after you satisfy the government, and then you take care of your short-term capital needs and long-term capital needs, okay? And after you take care of these, of the short-term and long-term, whatever is left is free cash flow, which is available to satisfy debt and equity. In other words, debt holders and stockholders. And that's it. That's the free cash flow. It is available to distribute after satisfying the business with its short-term needs, short-term capital, and long-term needs, long-term capital. That's all there is to it. So every business got short-term needs, it's got long-term needs. You make a certain profit, you take care of the short-term needs, you take care of the long-term needs. Whatever is left is the free cash flow. It can be used to pay bondholders interest. It can be used to pay down debt. It can be used to buy back bonds. It can be used to pay dividends to stockholders. It can be used to repurchase stock. It can be used in any way to satisfy liabilities according to judgment. All right? So business generates profit. You take care of the short-term side of the capital, take care of the long-term capital. Whatever is left is going to satisfy liabilities according to their desire. And that's the free cash flow. Let me read again from the book the strict definition. The amount of cash that would be withdrawn without harming a firm's ability to operate and produce future cash flow. The ability to operate is the short-term capital. Future cash flow is the long-term capital. So after you take care of the operating needs and the investment needs, all the other cash that's left over. And that's it. Here's an important note, which is in the middle of the paragraph that's important to understand. It's tricky. Analysts want to look at the free cash flow, and it's very simple. If a business is very profitable, it will be generating a lot of cash flow, a lot of free cash flow, okay? But there is a trick and there's a catch. And the trick to understand is that this is not actually true for rapidly growing businesses. If a business is growing very rapidly, it will need a lot of short-term capital. And it will also need a lot of long-term capital. So, for example, think this university is making huge profits. It is supposedly generating free cash flow, and then they say, oh, we're going to be opening a brand new dorm. They're going to put in 20 million in the dorm. Well, if the university is growing and it's building a new dorm for 20 million or for 50 million, it's going to eat a lot of the free cash flow to the point where the university might not have any free cash flow. Okay? So, it doesn't mean it's not profitable. Okay? It can be very profitable. And it could still have little or no free cash flow because most of the supposedly free cash is actually used for rapid expansion, for rapid growth. And how do you grow a business? Very simple. By making investments either in short-term capital, like inventory, or making in long-term capital. Okay? For example, you're a car dealer. You already have 3 car dealerships and 100 cars. You don't want to expand your business. Well, there are two ways to expand. The first simple way is buy and get more cars on the parking lot. So instead of a total of 100, you're going to have 150 cars. All right? Well, if you're going to increase the inventory by 50 cars, you need extra working capital or short-term capital. You need that extra capital to get the extra cars on the parking lot. So that's one way to do it. The other way to do it is to open a fourth dealership. And you need a lot of long-term capital to actually open a brand new dealership with a showroom. You got to hire new people and all the other expenses, and that will eat your profit. So a business can be highly profitable. It could be generating a lot of cash flow, but at the same time, due to rapid growth, you need a lot of capital, whether it's short-term or long-term, and the free cash flow is practically small, or it could be even negative. If the business has a free cash flow, negative cash flow, it simply means that it has to raise additional capital. It has to either issue additional debt or has to issue additional equity or some other form of borrowing, bank loan or whatnot, to compensate and to finance its growth. And that's it. That's very simple. So it is very common that businesses might be very profitable, but if they're growing too fast, they will need to issue extra debt or equity to further growth, and their free cash flow could be negative. And that's section 6. Section 7 is income taxes. And they're very different in different countries, so I'll just give you the basic concept. Basic concept is, first one, when I mean basic concepts, I mean concepts which apply to any countries, whether it's going to be Bulgaria, US, Japan, Taiwan, Vietnam. For any country, you have taxable income. And it's very simple. Taxable income is simply income on which the government will levy some tax. They might say 10% tax. So this is the income on which the government will be calculating tax. It's called taxable income. The second basic concept is called progressive tax. And progressive tax is very simple. As the income rises, the tax rate increases. And now we need a simple definition of a tax rate. And tax rate is simply the percentage of tax income that the government collects as taxes. So, tax rate of 10% simply mean that if your taxable income is 10,000, your tax rate 10%, the tax will be basically 1,000. All right? So, in a progressive tax, the tax rate increases with taxable income. The current alternative in many, many countries now and getting more popular around the world to progressive tax is called a flat tax. And a flat tax is simply a tax system where the tax rate is the same for all income levels, for all levels of taxable income. In Bulgaria, where I come from, tax rate is a flat tax of 10%. That's it. You pay 10% for everything. Doesn't matter how low or how high your income is, you always pay an income tax of 10%. Corporate taxes are actually exactly the same. corporations pay the same flat tax in Bulgaria of 10%. That's it. So as your income grows, you don't have higher, you don't have lower. Now, it also ignores things like, but we don't want to tax teachers. Teachers are good people, they educate kids. No, 10% is 10% for everybody. Bankers, greedy bankers, they still pay 10%. Lawyers, 10%. Politicians, 10%. So that's the idea of a flat tax. Here in Taiwan, the way I understand it, they have a differentiated tax. Okay, if you're a different type of a profession, or let's call it industry, you pay maybe higher, or actually in many industries, lower taxes. The government has the idea that we'd like to encourage this industry, and therefore we're going to have a lower tax rate. All right, let's see what else we have on taxes. Marginal tax rates. For any tax system, if you have a tax rate, you have a marginal tax rate. This is the extra tax which you must pay on an extra dollar of taxable income. So if your taxable income goes by $1,000 extra and your tax goes by $200, the marginal tax rate is 20%. So you measure how much your income goes up, taxable income, how much your tax goes up, and that's the marginal tax rate. So basically it is a change in tax divided by change in income. Again, this is a definition which applies to any tax system in the world. Okay? Doesn't matter the country. The next one is called average tax rate. This one is a little tricky, actually very tricky, but it's basically your total taxes divided by income. And the tricky part is when you say income, do you mean total income or you mean taxable income? And here the definition is taxable income. Taxable. So basically, this year, for example, somebody makes 10,000 of taxable income and their total tax is 2,000. Their average tax rate is 20%, basically. Okay, and there are additionally taxes, maybe, maybe not, depending on the country, on capital gains. So I have a capital gain. And capital gain is simply the difference between selling price and purchase price of an asset. Or we can also say of an investment. So this is the increase during the increase in value during the life of an asset. Example, you buy a house 50,000 5 years ago, now you sell for 60,000. The difference from 50 to 60, 10,000 is your capital gain. Okay? So that's a very simple capital gain. You buy stock for 20, you sell it for 15, that's a capital loss. In the United States, you have a capital gains tax, which basically says for all of your investments, you must pay a tax on your capital gains. In Bulgaria, we don't have a capital gain tax. So there's no capital gains tax. You invest in stocks, the price goes up, you don't have to pay any tax when you sell it. Not required, not in the law, okay? You buy a house, you sell it for double the price, you don't need to pay any tax, okay? So basically, that's, some countries have it, other countries don't have it, depending on the policy. Okay, and you have one last piece, which is just known as corporate income tax. Corporate income tax is simply a tax on corporate profits, on net income, or on the taxable income of corporations. That's corporate income tax, okay? And finally, some countries have and some countries don't have, simply called a dividend tax. And the dividend tax is simply a tax on corporate dividends. My home country, Bulgaria, has got no dividend tax, okay? Other countries do have special tax rates. They have a special tax rate for corporate dividends, okay? All right, and let's see what else. Oh, very important piece to understand, including the global financial crisis, is that today's U.S. income system favors debt over equity. When a business borrows and pays interest on its debt, the interest is tax deductible. In other words, on the interest, you don't pay tax. Okay? We say that the interest is taxed. So, taxable income is calculated by getting whatever your profit is and subtracting interest paid. Okay? Well, this provides what we call a tax preference on debt. So, do you want to issue debt or do you want to issue equity? If you issue debt for the interest, you don't have to pay tax. Well, if you issue equity, what you pay is called dividend, and if you have a dividend tax, suddenly equity is in unfavorable position. Suddenly you tax equity, but you don't tax the debt. And the result is a distortion in the system that favors heavily debt and disfavors or puts at disadvantage capital. So, given no other differences, in other words, if other things are equal, corporations, when choosing between debt and equity, will always favor debt. Well, debt, as we now understand, causes trouble possibly down the road. Okay, and debt needs to be refinanced and so on. So this provides for corporations favoring debt, and the result is higher leverage. And higher leverage comes with higher risk. So overall, the tax system could potentially increase the leverage in the corporate system, especially in the banking and financial system, and the result will be increased risk in the whole economy favoring debt over equity. And this completes the chapter and the lecture.